The first type of trade that we're going to learn is trend following. How do we capture a move higher or lower where we see the market trending, creating pullbacks, and expanding? There are a couple of primary pieces to learning how to trend trade with OFA. The first is we have to understand what a trend looks like. How do we begin defining a trend so that we know when to look on a chart for trend-based trades? It's very easy to see a trend after the fact. We can look at the chart in front of us and say, yes, the market moved up and there was a nice trend in a channel that was developed off of it. However, we need to be able to recognize this at an early phase so that we have opportunities to get into the market and capture pieces of the move. Most traders are unable to recognize a trend until it's close to being over. Let's take a few minutes to learn a little bit about what a trend looks like in terms of volume. I'm going to start by putting a very basic profile on this trend up. This profile is only showing us the volume. We're not looking at any other information at this point in time. And what we see is that after a move up, we have some small distributions of volume along the way up. And then once there's some consolidation, you can see that there's much more volume accumulated at the upper end of this. Each time that we have an expansion, you're going to see small distributions of volume. And each time we consolidate, you'll see larger groupings of volume. So that if we drag this across, you'll see that now there's a distribution of volume here, a small distribution of volume up above, a distribution of volume here where the last consolidation was. Anytime that we're in a trend, we're going to see expansion, consolidation, expansion, consolidation. And this is the type of thing that we ought to be looking for in our volume profiles. Now, it's important that we recognize this because if you notice, for each pullback that we've come back to, we're essentially hitting the other edge of the bulk of the distribution. So we trade up, we pull back in this case to the point of control, and then we expand. When we expand and pull back, we're pulling back into a major volume point where the consolidation exists. As the market expands up, we start to see more and more volume distributions. This is what any trend will look like unless it's just a straight move derived from news or something without much volume. We're going to see these little distributions of volume consecutively moving higher and higher. And the important thing here is that the volume profile on a trend only tells a very small piece of the puzzle. If we think about what a trend means, that buyers are continuing to buy at higher prices, then it makes sense that we might want to track the progress of that by other means rather than just price or these distributions of volume. In OFA, we can, in any distribution that we choose, we can not only show the profile of volume, but we can also add the volume-weighted average price. So in the settings, by double-clicking on a profile or by selecting a profile that already has the VWAP shown, we can enable this, and now we can see the volume-weighted average price of the individual moves. This is important because if we're expanding, we're having more buyers come into the market at higher prices. So we would want to see the VWAP continue to rise, indicating that more buyers are trading more volume at higher prices. That's indicative of a trend. What we find when we put a volume-weighted average price across a trend event like this swing here is that we're constantly seeing the market push back towards the average. This is known as a mean reversion. If you were to look at trading strategies, generally you have two types of strategies. You have trend following and mean reversion. Mean reversion trades are generally looking for when the market has expanded, looking for it to revert back to the mean. The mean is the volume-weighted average price. And by having the capacity to drag and drop a profile with a VWAP anywhere on the chart that we want, we can isolate these individual events. Most traders that are looking at VWAPs are looking at the VWAP for the entire session, maybe for a series of days, the VWAP for the last week or month. We have the ability to isolate the VWAP into these individual events so that when we start looking at a trend, we can see that the market is constantly pushing back towards the VWAP, never crossing the VWAP. It's always working as a lower boundary until eventually the market will trade across the volume-weighted average price. That would indicate that now we have sellers that are selling below the average price, and the trend essentially is invalidated. So the VWAP is a very important tool that we use, and we primarily use it for managing our stop in a trend. Another tool that we can look at is taking the standard deviations of the VWAP. So if I double click on this again and select my standard deviation lines, I can set up as many as I want on here. But what happens is it draws these little lines out, and what that shows us is the market expanding into standard deviations of the volume-weighted average price. So here we've expanded 2 standard deviations from the VWAP. A lot of times we're going to find support and resistance off of the standard deviation lines. The market generally will not advance further than a couple of standard deviations before there's a retracement. And we can see that as we trade into some of these standard deviation levels, that as the standard deviation expands, the market hits points and begins retracting. So the standard deviation is a good guidance for you, as we generally won't get more than 2 or 3 standard deviations away from the volume-weighted average price before we begin to see those mean reversions. Here is 2 standard deviations, and the mean reversion is beginning. We're coming back into 1 standard deviation at this point. So the standard deviation is something that we can add to a swing profile to always give us a little bit more guidance, perhaps provide us with additional points on the chart that we can move stops to if we want to accelerate our stop to reduce risk. It's important that you note how the VWAP acts as a barrier for pullbacks. Here we pull back to, but not through the VWAP. Here to, but not through the VWAP. Again, here to, but not through the VWAP. So that VWAP is always acting as an outer barrier for us. And logically, when we build a trade strategy around the VWAP, we want to use this as a trailing stop, and I generally create algos, management algos, that put me a tick or 2 behind the volume-weighted average price. Every market is a little bit different. If you have thinner markets, gold is a good example of a market that's a little bit thinner than, say, the ES or crude. A lot of times, thinner markets will trade instead of just to the VWAP, it'll trade a couple of ticks through the VWAP. So you're going to want to look at the different markets. You're going to want to draw different lines and see how the market is reacting to the volume-weighted average price. There's not a fixed, perfect number that covers every single market that's out there. But if you have a good trending market like crude, or this is the euro that we're looking at, when the ES trends, it works very well with the volume-weighted average price. It just doesn't trend all that often. So you have to be able to recognize a trend. You're going to want to study it and figure out what the best offset for your stops are. The important thing here, though, is that if we realize that the market tends to pull back towards the VWAP, not all the way to it, and then expand. So at OFA, we decided we needed a way to accelerate the VWAP to give us a leading indicator to trade off of. So we can see that at no point does the market cross the volume-weighted average price, and here it's working as a bit of a barrier for a stop. I now want to add what we call the CWAP. The CWAP stands for cluster-weighted average price, and I'm going to add it to the chart, and I want you to see the reaction that we get as we touch the CWAP and move higher. Here we're touching the CWAP, not crossing the VWAP, and moving up. Touching the CWAP, not crossing the VWAP, and moving up, same as here. Touching the CWAP, not crossing the VWAP, and moving up. The CWAP takes, rather than all of the volume in the event, it takes the volume only from the clusters of trade that OFA identifies in our charting data visualization. That allows it to be exponentially accelerated. So there's always going to be a spread between the CWAP and the VWAP, or most of the time there will be. And some of those opportunities will be excellent for putting on a trade. For example, down here, we have a spread between the CWAP that comes in at 66.75 and the VWAP at 66.25. Not much of a stop required there to put on that trade. Same with here. From the CWAP, it is 1, 2, 3, 4, 5, 6, 7 ticks down to the VWAP. There are going to be situations like this one where even though we're crossing the VWAP, you can see this is probably a 12 or 14 tick stop here that would be required to put on this trade. So there's always going to be a contention of risk. If we're using a leading indicator and we just trade it blind and say, well, every time it crosses this, I'm going to put on a trade here and my stop is going to be behind here, we may end up with trades that have very, very large stops. And that, of course, makes it very difficult to make any sort of multiple on what you're risking. The key to trading and compounding your account is understanding that if you have trade opportunities with very small stops, the trades don't have to go very far for you to be making a multiple on what you're risking. So if you take a professional approach at trading, you're not interested in always trading a one-lot position or a two-lot position. That doesn't make any sense. What we're looking for is risking some portion of our account every single time, so that when I have a very small risk, I can trade a large size, and I don't have to go very far to make a multiple of that. When I'm trading a larger risk or a larger stop, then I want to trade a smaller size because I know that it's going to be harder for me to get a multiple on my risk as a return.